What I have for you this week is a very short video on some of the examples that the UN is giving us on financial transactions and intergroup transfer pricing. So you have on the left, you have the 2021 UN Practical Manual, and on the right, you've got the 2019 draft paper from the Committee of Experts on International Cooperation in Tax Matters. And they have written a draft chapter, which is very much like the OECD Chapter 10. It misses a few sub-chapters, such as on reinsurance, but it follows basically the doctrine of Chapter 10 as well. And the difference between the draft and the final 2021 Practical Manual is that the Practical Manual includes a number of interesting examples, of which I discussed the first few in this video. So let us go through a couple of examples that the UN has given in the financial chapter. The first one here you see LCO, which is lender co, I suppose, and BCO, and there's a loan between LCO and BCO, and it's a very simple example. There's no maturity date on the loan, there's no security given for the loan, the interest is contingent on BCO's results, and the loan is used for a new business concept because basically BCO's current business concept is running out of its economic life, and it is expected that there's insufficient income to serve the interest due in future. And the question is this a loan? And the UN concludes and says, well, first of all, the loan may not be debt for TP purposes because of the characteristics here above. So you look at the characteristics itself and decide this cannot be a loan. But then they go on to say, interestingly, that even if you decide that the instrument is a loan, because of its, I guess, contractual characteristics, etc., etc., it may still not be commercially rational, and it could still be recharacterized. So it seems like there's a two-step process here for the UN, where one, you decide is this a loan at all or not under Chapter 9.7 for the UN and 10 for the OECD, and then two, even if it is a loan, you can still trip up under the accurate delineation of the transaction. And you can still come to the conclusion that, actually, it's not a loan. A 10-second commercial. If you want to learn more about international taxation or transfer pricing, or treat yourself to an all-round update, or if you want your team to learn or stay updated, please visit my online courses. In our next example, still dealing with loan recognition, you've got AECO 1 and AECO 2 are related parties in country A and C, and AECO, and then you've got an unrelated shipbuilder. And AECO 1 needs for its business a special ship to supply it with raw materials for the products that it makes. So AECO 2 actually signs the contract with the unrelated shipbuilder, borrows money from AE1 to pay for it, and AE1 also gives a parent guarantee that AECO 2, which is a newly incorporated company, will perform as required under the building contract. So if we look at the facts quickly, 1, AECO 1 requires a special ship for raw materials. 2, it finds negotiated a contract with the shipbuilder. 3, AECO 2 then signs a shipbuilding agreement with a parent guarantee. This happens quite commonly in the industry where you build heavy equipment and you have SPVs actually owning it. And then AECO 1 gives $100 million loan to AECO 2 because that's the cost of the ship. And the loan is convertible to equity within 5 years at the behest of AECO 1, or it can be redeemed by AECO 2 within 3 years at $105 million, which means that you pay interest of about, I don't know, 1.5%, a little more than 1.5% per year if you do it after 3 years. So the ship is built after 1 year. It has a market value of $110 million already. And AECO 1 converts the loan into equity after year 3. And then country A and country C disagrees about whether this is a loan or whether it ever was a loan. Country A says this was a loan and AECO should have paid interest, and country C says, well, we don't think it is a loan, and the interest was never due. It was equity from day one. And then the UN comes and gives a number of questions that one can ask in order to try and characterize this loan. And the first is, were there commercial or legal reasons to have a company in country C? So was this a tax planning issue, or were there real reasons why you needed a company in country C? I mean, I would add to that question, are there any differences in tax rates? The second one is, what are the characteristics of the loan itself? You know, it was redeemable, it was convertible. What else was there? Was a security given or anything like that? Third question would be, what would a third party have lent to AECO 2, considering future cash flow size and timing? And the issue here is, you know, well, when you need to know what kind of guarantees does AECO 2 have? I mean, can a future third-party lender just take the ship instead, or something like that? The next question dealt with by the UN was, what is the risk of budget or timing overrun? If the shipbuilder did run over budget, you know, were there penalty clauses in the contracts dealing with such, or the same for timing? The facts do not say. And then the final question proposed by the UN is, what is AECO's 2 standalone credit rating? Because it probably would have been a high risk rating leading to lots of interest. And then the question would be, what kind of interest would AECO 2 be prepared to pay for such a loan? I think the UN keeps these examples relatively simple because we're still pretty much at the beginning of the chapter of financial services, which is why it doesn't address issues like, you know, what about the guarantee? Should AECO 2 pay for the parent guarantee and stuff like that? Let's see what is next. The next UN example, we have a group called the ABC Group. They are in money transport and they've got a very well-established, strong brand. You've got ABC Parent, ABC Concordia, and XYZ Limited. Now, ABC Concordia has a third-party loan, and ABC Concordia is in a bit of a strange country and running into trouble. And now the issue is, what is the effect of implicit support on the group reputation, right? If ABC Concordia defaults on the third-party loan, the issue is that ABC Concordia has the same name as the ABC Group, and that is going to hurt. Secondly, ABC Concordia in this example has the same business as ABC Parent, so it's in a money transport business, and if ABC Parent allows ABC Concordia to default, then that is going to be a problem, and it's really going to hurt it's possibly going to hurt, let's say that, the credit ratings of the ABC Group. On the other hand, if you are the ABC Group and you've got some small subsidiary somewhere called XY Limited, first, you have a completely different name than the group itself. Secondly, XY Limited in this example is in the business of cash sorting machines, which is a tiny part of the business of the ABC Group. So the conclusion here is, if XYZ Limited were to default on any loan and ABC Parent doesn't come to its rescue, then it is likely to have less of an effect on the ABC Group's credit ratings, according to the UN. Our next example on loan maturity, we have ELCO, which lends money to BCO, and BCO buys fixed assets with that loan. So the facts very quickly, the ELCO extends a 12-month loan at short-term interest rates to BCO in 2017, but then ELCO extends the loan in 18 and in 19 because it's not yet repaid, and BCO doesn't have the cash to repay it. In these circumstances, one should conclude that the loan is not a short-term loan, considering the behavior of the parties. Secondly, it is also not a short-term loan because it was used to buy long-term assets. Where would you get the money from to repay the loan? And then finally, this means that the loan should not be priced as a short-term loan, but as a medium or a long-term loan. The UN gives a number of further examples on accurate delineation of loans and cups for loans. So in example 5, it talks about currency, and it says if ELCO and BCO conclude a loan in currency X, but in reality the cash is extended in currency Y and the interest is paid in currency Y calculated on the outstanding amount of Y, then the conclusion must be that the loan's currency is Y and not X. It seems pretty obvious. And then the same for loan security, and this is an interesting case because it actually references back to the Chevron case from Australia. And what happens here is ALCO and BCO conclude a loan with no security, which means there will be a higher interest rate. BCO has no other loans and all its assets are pledge free. And then BCO previously provided security on previous loans, and ALCO normally requires security on loans, as it is group practice to provide security both for intercompany and third-party loans to pay lower rates. And the conclusion for this transaction would then be that the loan should be treated as being secured unless the parties can show that there is some significant commercial disadvantage on having the loan secured as opposed to paying the lower intercompany interest rates. This finishes the examples on delineation of the loan. So let us now look at cups. In our first example, we've got internal cups and we've got ACO, which extends in X, extending a loan to BCO in Y. BCO makes a comparable loan from a third party, and as can be expected, the UN says that the ACO loan could be the same interest as the BCO, as the third party loan. But the interesting thing is the UN says then unless the third party loan reduces the BCO credit rating. And this is obviously something to consider, right? Because comparable loans may, for instance, be giving security on those loans, right? And if the third party loan has already got security on all of BCO's assets, then it's going to be a little difficult for ACO to do that. And even if there's no security, if it is quite clear that you know, it will be difficult for BCO to service both the third party and the ACO loan, and it's more likely to service the third party loan than the ACO loan, then the ACO loan carries more risk and should have a different credit rating, also apart from BCO's own credit rating before and after the third party loan. In the next example, we look at external cups, and you've got ACO lending money to BCO, and then there's public information about comparable third party loans, assumingly from some kind of commercial database, and the conclusion obviously is here that you could use the same interest as the third-party loans because they are comparable. And example 9, if you can't find third-party loans, but you can, for instance, find data on third-party bonds with similar or comparable maturity dates and interest rates and security requirements, etc., then one could use those third-party bonds and the interest on them as a price for the third-party loan, for the loan between ACO and BCO. Okay, so next we're going to look at the interplay between loans and other intercompany transactions. And in this particular example, ACO sells goods to BCO, its group distributor, and BCO then sells those things to unrelated distributors who both can be ACO, BCO group customers, large one, but it can also be BCO's own customers. And if we look at the facts, and ACO sells to BCO, BCO has benchmarks which shows that a 1 to 3% return on sales TLMM gives you an arm's length range, and that is on an EBIT level, and BCO makes 2%, so BCO is fine. However, BCO then extends customers' payment terms from 1 month to 6 months without getting a corresponding extension on the payment terms from ACO to BCO. And because of this, BCO needs more money to finance these extended payment terms, and the interest rate, which is at arm's length on this loan, actually wipes out the EBIT of BCO. And the tax inspector looks at this and says, you know, what's going on here? And he sees that the new payment terms are demanded by both group customers, which can show a favor to ACO, but also to BCO's own customers, which makes it back to more being a commercial requirement again, right? And he also noticed that BCO did not increase prices when it gave the extended payment terms because it was to retain and expand its client base, which is why he did it. So the conclusion of the tax inspector, and I really like this one, is it said that the extended payment terms led to changes in the working capital of BCO. Obviously, that makes sense, right? And this influenced the comparability of the benchmark. So actually, the original benchmark was not reliable anymore. And what you need to do is you need to make comparability adjustments to the working capitals of your comparables, and that will lead to BCO needing an increased EBIT range. So it needs a higher profit, which means that ACO would need to sell the goods to BCO at a lower price. And then if we get to example 11, then the facts are the same as they were in 10. But it also turns out that BCO deals with seasonality in sales, and that causes spikes in the requirements of its working capital, because it obviously needs, after it had a season of high sales, it needs more cash to pay ACO, which then it has to wait for before it gets the money from its customers. And what happens here, and I again like the conclusion of the UN, they say, in this case, it's better to benchmark on EBT over sales than EBIT over sales, because it will give you more reliable results. But there is a but, and that is that the loan that should then only be used for working capital and not for other things. And based on this condition, one could then again adjust the price between ACO and BCO. This is what I wanted to show you in examples. There are a few more. They are included in the course, but I want to keep this video short. I hope you enjoyed them, and I look forward to discussing some cases again next week. Bye for now.